we are back looking at more organizational controls, and here we are starting with the definitions of financial controls and budgets. So we know that controls can be either financial or non-financial, and organizational control procedures that are effective will allow a manager to look at actions in the organization and regulate those actions so that they align with expectations within the organization. That's why we have controls. So we have expectations for what should happen, and then we need to monitor and regulate to see whether that is happening. And so here we are looking at financial controls, not the non-financial kind. That's a different video. So financial control, the definition is the management of a firm's cost and expenses to control those in relation to what has been budgeted. So management in an organization will take a look at its financial condition. For instance, assets, sales, profitability, most importantly, tries then to forecast them through these budgets. And then after that has been done, managers will compare what actually happened, the actual performance, against those budgeted amounts. So they set a budget and then see what happens and then compare the two. At a strategic level, total sales and indicators of profitability are great, relevant strategic controls and are looked at often. That is, financial controls are executed by monitoring costs and expenditures in relation to an organization's budget. That is what financial control is all about. A budget definition then is a listing of all of the planned expenses and revenues. A listing of all of the planned expenses and revenues. An overall budget often includes a monthly or quarterly projection of what the balance sheet and income statement will look like based on those planned expenses and revenues. And we have different videos looking at balance sheets and income statements. All right, so with that, we are heading into some other financial considerations that relate to control in organizations. Companies often do something called a financial audit, and financial audits are done to make sure that the financial management practices that they have in place within the organization follow generally accepted procedures, policies, laws, and ethical guidelines. These financial audits are really formal investigations into the financials of a company. So it's a formal investigation looking at how the finances are being handled. Audits can be conducted either internally in the organization, then it would be done by, for instance, the accounting department's employees. They can also be done externally by using outside accounting firms that have been hired specifically to do these financial audits. So that would be an external audit. Secondly, we have something called financial ratio analyses. These look at the relationship between specific numbers on these financial statements to see what is going on. So we do analysis to explain the significance on numbers on these financial statements. By analyzing these financial reports, organizations can look at how well they're doing. It also helps pinpoint actions that we might want to take to make sure we are healthier financially. So, thirdly, taking a look at the proactive manager versus then a reactive manager. So our actual financial performance in an organization is historical, meaning it's in the past. Anybody who is proactive in nature, the proactive manager, they will plan ahead for any problems that the business is likely to encounter. Because we can't do much about the past, so it helps to plan for the future. These proactive managers are also on the lookout for any opportunities that they didn't know, but that can come about. So to do this, these proactive managers use what is called a pro forma financial or pro forma financials. These are projections, and usually they are done for 3 fiscal years. So a projection for the next 3 fiscal years. Being proactive really requires reading and analyzing financial statements on a very regular basis. This can happen monthly or even daily or weekly. So reading the financials is common in many industries on these timelines, such as monthly, daily, or weekly. The proactive manager also has the financial data available based on the actual results and then comparing them to the budget on this regular basis. Doing this helps identify any weaknesses before they reach crisis proportions, and it also allows the company to make necessary changes before major problems develop. So that's really how an organization wants to deal with reading the financial statements. A reactive manager, on the other hand, really just waits until there is a problem, and then they solve the problem, and they do that by crisis management. So a reactive manager goes from crisis to crisis, and they have little time in between to see if there's any opportunities going on, and so they are seldomly well prepared to take advantage of good things coming their way. So we want to make sure we are proactive with reading our financial statements. So that's it for organizational control, financial control, budget definition, and some other financial control considerations. Have a good one, and I'll see you at the next one. Bye-bye.